Welcome, everybody, to the distinguished AFA lecture for 2020. I'm Ken Singleton, and it's with a great pleasure that I get the honor of introducing our speaker, Rob Townsend from MIT, the Killian Professor of Economics at MIT. Rob and I go way back. He was involved in hiring me at Carnegie Mellon in 1980. At that point, Rob was my senior colleague amongst a bunch of very young colleagues at Carnegie Mellon. I think he had reached the associate professor level at that stage. We were a young group. It was an exciting group, and it was fantastic for me to be introduced to the world of thinking by Rob Townsend. As if anybody, those of you who followed his research over the years, it's truly an impressive body of work. He came out of Minnesota with a PhD, went to Carnegie, where I met up with him in 1980, subsequently left to the University of Chicago, where he was there for quite some time, and then has moved on for over 10 years now to the Department of Economics at MIT. His work early on in his career on optimal contracts with costly state verification and related work was just path-breaking and still very influential today. He, in addition, developed micro-founded models of money, and in fact, that was my first introduction to those models, and I learned an enormous amount from him. And then he shifted gears quite dramatically and went in the direction of development economics and is now one of the leading scholars in the field of development economics, but he still has this deep interest in financial infrastructure and systems, and he's circled back over the last few years back to his early work on theory of money and his long-standing emphasis on general equilibrium systems in financial markets, and is going to talk with us about distributed ledgers. So with great pleasure, let me introduce Rob Townsend.
Thank you, Ken. A very gracious, generous introduction. And thank you for inviting me to give this lecture. It's a big opportunity to share what I've been thinking about rather intensively over the last couple of years. So I could have put Bitcoin on the title, or maybe blockchain, which are, sort of more interesting words. But in my view, intellectually, that's misleading because distributed ledgers are at the root. They came first. Blockchain came subsequent to that, and that was even before Bitcoin. Although certainly I recognize that a lot of attention these days is on Bitcoin, continues to be focused on Bitcoin. So I'm going to give this talk in reverse, from distributed ledgers to the blockchain to some words about Bitcoin. Let me read a quote about distributed ledgers and their importance. Contracts, transactions, and the records of them are among the defining structures in our economic, legal, and political systems, and yet these critical tools and the bureaucracies formed to manage them have not kept up with the economy's digital transformation. They're like a rush hour gridlock trapping a Formula One race car. With blockchain, we can imagine a world in which contracts are embedded in digital code, stored in transparent shared databases where they are protected from deletion, tampering, and revision. So let me give you a more precise definition of distributed ledgers along with some examples and some caution. Distributed ledger technology refers to the processes and related technologies that enable nodes in a network or an arrangement to securely propose, validate, and record state changes or updates to a synchronized ledger that is distributed across the network nodes. There's a lot to take in there. I'm tempted to read it twice, but I won't. So distributed ledgers are in use. Digital Assets is a company that is changing the Australian Stock Exchange, Maersk Shipping Company, an accounts receivable platform in India called Treads, various distributed ledgers for recording and transferring titles. IBM has created something for Walmart to track potentially contaminated vegetables, and Ripple and Stellar are international fiat money transfer companies, profit and not-for-profit respectively. I could have put more on this list. It would have overcrowded the slide, but a related point is it's really treacherous to pick only to discover that it didn't actually happen. So an example would be Digital Asset, the company I mentioned with respect to the Australian Stock Exchange. They, in conjunction with the clearing DTCC, and with the encouragement of the Federal Reserve, we're going to set up a distributed ledger to enhance reconciliation in the repo market in New York. And despite the obvious importance of that endeavor, since it currently takes 2 hours every single day to reconcile the trades, it didn't happen. With some caution, I could put Libra under that title. It hasn't happened yet either. Some people think that it will, but it is part of the quote-unquote hype that surrounds this field. And, to mention, there are obvious cases of fraud. For example, Dow basically stole 50 million, subverted it to uses that were not permitted, and Tether is a cryptocurrency that claimed to have 100% backing of the US dollar, like a narrow bank, and it did not. I think they've come down to 82.5 or something, but it took a long time for them to fess up. So in addition to the hype and the fraud occasionally, sorting out the good from the bad, there's controversy. In particular, this could be a pen name or a pseudonym or a non-person, I suppose. Satoshi Nakamoto, his white paper says, with regards to Bitcoin, that what is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties, and he could have said strangers, to transact directly with each other without the need for a trusted third party. So at a minimum, he's quite clear about what the objective is. This wasn't lost on central banks, or so, for example, speaking for central banks, the BIS says, decentralized technology of cryptocurrencies, however sophisticated, is a poor substitute for the solid institutional backing of money. Don't mess with my fiat. Now, another comment I want to make is like, what's new? So people are constantly searching for, if it isn't brand new, then it's not really any good. But I want to distinguish very much innovation that comes after an invention and may in fact take quite a while and may already exist in some contexts, but when introduced in another is a true innovation. So, and finally, on this litany of the first 8 or 10 slides, misleading definitions. You'll often hear in the industry these words, decentralization. It's wrong. The synchronization of so-called decentralized ledgers actually requires centralization or coordination across all the nodes. Another word you'll hear is disintermediation. And what is meant by that, if it's a good thing, is disruption in the sense of eliminating oligopolistic markups. But to me, disintermediation is a misnomer, because certainly intermediation or mediation, as in financial platforms and money, are very much what is on the table in terms of innovations. So let me give you the strategy of this talk. I'm going to talk about the economics of what distributed ledgers can do, and I'm going to do that by analyzing key individual components separately. So one could have a very useful platform or product or tool if it did one thing, even if it didn't do all the others. I'm not going to fall into the trap of calling something a distributed ledger only if it does all four things. In fact, I'm going to compare, contrast, and try to innovate by merging for each of these functions the economics framework with the framework of computer science and data science management, which will help clarify the technology and, as I'm saying, ideally propose new designs. I'm going to put each of these component parts in context and try to give you examples, either historical or contemporary, from advanced countries or emerging markets. And again, the goal here is to emphasize what each component of distributed ledgers brings to the table. So one context I will refer to off and on is Southeast Asia. As Ken was alluding to, I have a foot in development economics, and I've been running a project collecting data there for over 20 years. And this part of the talk, when I get there, will be very much about financial access and whether distributed ledgers can help achieve that, which is a formal goal and widely recognized now by the G20 and by many central banks as on a par with traditional monetary policy functions. There's some details on these slides about these surveys, which would probably take me too far afield, but the pictures tell part of the story, going from Thailand in Southeast Asia to various provinces in Thailand, to a blow-up of a single province with the location of banks and villages and road networks and so on. So when I say in context, I could mean a village, I could mean a region, a national, or even international economy. And likewise, I'm not going to restrict attention simply to emerging market countries. I'll have a lot to say about advanced country financial systems. So when I say an economy, I mean, as again Ken was saying in the introduction, general equilibrium, specify preferences, endowments, and technologies, and then try to make a judgment about what distributed ledgers may or may not be doing. But there's various criteria one could choose from in making those judgments, and one would have thought they're all alike. For example, we have obstacles that prevent financial access. Let's get rid of the obstacles. Sounds like a good criteria. Or if you have companies doing it, if it's worthwhile, they should make profits. Or alternatively, we could have the Pareto criterion for allocations. Well, these criteria are not all the same. In particular, when it comes to monetary economics and cryptocurrency, the welfare theorems will fail or can fail, so that what is a competitive equilibrium may not be Pareto optimal. Anyway, with exceptions, I'm going to be focusing on this Pareto criteria to try to evaluate designs and focus on optimized designs and optimized regulation, often using this technology itself. So here's the outline of the talk. I'm going to talk, as I said already, about the economics of distributed ledgers, and these four component parts are ledgers as accounts, e-messages and e-transfers of value, cryptography, and contracts including multi-party mechanisms. Then, after I go through each one of those, I will turn to some universal design issues that could apply in many different types of economies, optimally concealing information, delegation to third parties, tokens as decentralized systems in relation to partition ledgers, and how to mitigate runs on markets or banks. I'll then turn to emerging market applications and feature some innovations that are going on with respect to financial infrastructure and payments. Next to last, I'll focus on distributed ledgers in regards to regulation. And finally, some comments on tokens and cryptocurrency at the end. Okay, so first component part, ledgers, as in distributed ledgers, meaning accounts, financial accounts. Ledgers are financial accounts, which may be a big turnoff. Maybe that's why people refer to these things as Bitcoin or blockchain, as opposed to we're going to do some accounting. But accounting is a central part of the ledgers, hence the name, keeping the books. Bitcoin is both a stock and a flow. If you're conceptualizing it, Bitcoin in some value would appear in a balance sheet, and the flow would appear if the transaction takes place in the statement of cash flow. And the income statement, statement of cash flow, and the balance sheet are the three standard financial accounts. Then we can think about an application of how to create ledgers and how to, in particular, distributed ledgers. If you allow me to turn back to my Thai roots, the Thai village where I have all these 20 years of data, we measure for each household their transactions in currency monthly. The next step would, and we did, put that cash flow onto their own individual accounts, but they could have been put on a common ledger so that now we have an integrated database across all the participants. And in particular, if some household I transacts with J, and they tell us that, the question arises whether J is in the database. And if J is in the database, J should be also reporting that exact same transaction with I. Well, it doesn't always turn out that way. Unfortunately, we didn't collect the data with distributed ledgers in mind. But the point is that a big plus for distributed ledgers is that it uncovers discrepancies, and it can do this in real time. So if nothing else, of the other three components, this one alone is a very big, worthwhile innovation. This is what's going on with digital assets in the Australian Stock Exchange. There's no need for T+2 to settle trades 2 days later. Two parties, A and B, meet on an outside trading platform. Say bilaterally, they agree to do a trade. The information is sent by the trading platform to a clearing exchange, which writes encoded messages on the distributed ledger, which in turn can be read by the parties A and B, referencing a contract ID. Nobody else can read the transaction. This is run through a digital assets DAML code on their in-house contract and verify that the exchange is what they agreed to. So virtually instantaneous reconciliation. The analogy here is to double entry bookkeeping, and we are talking about accounting after all. So double entry bookkeeping allowed much greater accuracy of the ledgers because there's a lot of checks between the flows and the stocks. And I would argue that distributed ledgers is that order of magnitude in terms of the accuracy achieving higher accuracy of measurements. Okay, but then we get to some issues of database management. If these ledgers are a database, do we want a traditional one or do we want this new distributed ledger one? Well, there's some interesting work in database literature. A traditional database is, dare I say, cruddy. This is the language they use, meaning CRUD. A traditional database, the user can create, read, update, or delete lines. So there's a big risk there because anyone with sufficient access to that traditional database can destroy or corrupt the data. Users are therefore reliant on the security infrastructure of the database operator and must trust that operator. And, you know, incidents you're probably aware of come to mind recently, and many others. The alternative is decentralized ledgers, but that raises problems. It's not so as easy as it might seem. There's another theorem, the so-called CAP or CAP theorem, which states that it is impossible to simultaneously provide more than 2 out of the 3 following items. First is consistency, where every read receives the most recent write or an error. Availability, where every request receives a non-error response. And partition tolerance, in which the system continues to operate even and does not cease operations despite the existence of multiple versions. The consensus problem of distributed computing, it's impossible to guarantee that any asynchronously connected set of communicating nodes can agree on anything. Another famous theorem. The key word being asynchronous. If the nodes are synchronized, then more is possible, but you have to choose as in CAP. So for example, when a network partition occurs and there's multiple versions of the quote-unquote truth out there, one has to decide whether to cancel the operation, which decreases the availability, but would ensure consistency, or on the other hand, proceed with the operation, but risk inconsistency. And various algorithms typically take a stand on these trade-offs, and that involves costs. We probably ought to be thinking about hybrids. Hybrid systems emerge in practice. They are between these extreme points of strictly hierarchical military command control traditional databases on the one hand, and fully connected, synchronized network meshes in which all the nodes are connected to all the other nodes, which do not scale. That's the scaling problem. These hybrids are out there. It's harder to find out about them because of this religious fervor that surrounds the field. And they're out there potentially not as deliberate choices, just something that seemed to deal with the 2 endpoints. One could think about designing systems like constrained optimal partitioning. And then there are examples of this. For example, if there are costly bilateral connections, that can lead to subgroups where not everybody is connected to everybody else. Fixed cost per connection creates ever-decreasing per capita costs, and a model with risk, an increasing number of connections has ever-increasing marginal gains, but it can happen that the marginal cost of adding one more node exceeds the marginal gain, and you truncate the size of the group and start over again. So this is an economic way of thinking about how to create optimal hybrids. Second component, e-messages and e-value transfers. So from, again, the work in Thailand, we've created the statements of cash flow and balance sheet for each of the households. And this picture, you can't no doubt not read the scale, is a typical household that ends up holding 37 months worth of currency in the house. 37 months worth of consumption in currency in the house. And that is typical for this database, so it's inefficient, let's say. If you go from a currency system to Sweden, it's a virtual e-world already. There's hardly any currency left in the country. This graph shows the nominal value of kroner still outstanding, which is, and also the amount of currency and notes relative to GDP. The picture here is I got from the governor of the Bank of Sweden is a phone, as in using your phone to transfer value. Ironically, the picture is transferring those stones that used to be the basis of the monetary system using your phone app. So in between these two extremes, Thailand, all currency virtually, and Sweden, virtually no currency, we have countries like Kenya. So M-Pesa, run by Safaricom in Kenya, has agents out in the city blocks and countrysides. You go to an agent, say, convert your Kenyan shillings to currency to e-credits, cell credits, on the phone, and then you can transfer those cell credits to buy things, or in Nairobi, sending money back home, for example. You now have a dual system. You have a fiat currency system with physical tokens, the fiat money, circulating around jointly with the e-money. People have studied this M-Pesa system, which, by the way, has been adopted by over 97–98% of the country, including low income and people without any other financial access. So it has been a huge innovation, although it's a rather mundane thing, like PayPal and so on, but they hadn't had something like this before. And it's allowed better insurance against fluctuations and is associated with a welfare gain. Now, to come to the limitations of Safaricom systems, trust and missing infrastructure. So Safaricom is the trusted third party of the kind that Satoshi did not want. The token transfers rely on distributed ledgers with immutable records and some kind of consensus validation. They're not doing that in Kenya. I'll talk about that in a second. Also, taking into account the larger financial system, banks hold Safaricom accounts, effectively holding the customer's shilling accounts in the bank, and banks in Kenya and many other countries are subject to runs. So again, we see the issue of trust. So I said earlier, you could have an innovation that has great value, but it may not tick off all the boxes in the other components, and I leave you to think about that. Another odd thing about the Kenyan is the shortages. When they go to an agent, the agent can't create liquidity, so they are limited in terms of their own ownership of e-accounts to transfer to the customer, and more obviously, they may not have the Kenyan shillings to allow the customer to cash out, which is a big part of the system. You see these shortages in Kenya that are picked up in surveys. I know for sure that surveys of bank agents in Indonesia are picking up the same problems. And when people talk about broker-dealers in New York, in the financial markets, they're also talking about broker shortages, and when it works, brokers effectively providing insurance by providing liquidity. So this is a common problem across a whole variety of countries. The infrastructure is informal in Kenya, and currently and in general, infrastructure pieces are different from the cryptocurrency pieces. These tokens that I'm about to describe later are exchanged on cryptocurrency exchanges that are largely built up as traditional systems, namely with trusted brokers and so on. So people go to great lengths to create these tokens that are, relying on the absence of third parties for trust, and yet when they exchange them, they typically rely on traditional infrastructure. I'm not saying that it's good or bad, but it certainly begs the issue of what we would like to think of as an overall optimized design. Third component is encryption, and that's not new either. Here we have a picture of tokens in Mesopotamia, these cylinders, etc., which represent quantities of grain and so forth that were put in clay envelopes and sealed. So the idea is that the shipper and the receiver of the goods want to prevent tampering. The recipient wants to know what they're getting in terms of inventory, like a manifest. So if you steal the goods, if there's a third party stealing the goods along the way, it won't reconcile with the manifest. If someone breaks open the clay envelope, it becomes obvious as well that there was tampering. So this is a way for two trusted parties, the shipper and the receiver of the goods, to know that there was no third party tampering in between. And by the way, the writing on the envelopes becomes the Mesopotamian script. So money messages have a deep history. Here's another example, the tally sticks of medieval England. Another example of cryptography. Sticks, willow sticks, were split in half from one end to the other. The debtor held one and the creditor-lender held the other. Willow, it turns out, has a natural distinctive grain, and the two halves would only match each other, a bit like fingerprints. So the original borrower, who was trusted to repay the loan, could trust that when not necessarily the original investor, but a third party comes with half the tally stick for presentation, that it was a real record of the original debt, as opposed to someone presenting a false claim, like double presentation of debt. The picture at the bottom is for your amusement, to ponder new systems. Eventually, they decided to convert to paper, the new modern object, and get rid of these wooden tally sticks. They didn't want the employees to take them home, so they burned them in the chimneys of the Houses of Parliament. Parliament caught fire. This was the third worst fire ever in London. So you can think about where we're heading. Okay. Contemporary encryption is associated with private and public keys, and yet that doesn't solve the double spending problem. So public and private keys ensure that no one can transact on someone else's ID, no one can impersonate a node, and because the message or the transaction can only be created with the key combination, it is known that the spender wishes to unlock and spend the coin. So this brings commitment to the transaction. It cannot be undone or reneged upon later. It's an immutable history. Still, double spending is possible if two messages were sent from a given node able to spend the same coin. That is possible due to internet latency, where transactions do not appear on the other end instantaneously, and it only takes a few seconds to spend something twice. Therefore, it would be hard to know which of the two transactions is valid. because the timestamps are not necessarily in chronological order. So the solution in computer science is based on the concept of distributed computing. The idea is that validators in a network have to achieve consensus over which transactions are valid to approve the next block of transactions. See how finally we get to blockchain. Bitcoin and Ethereum use proof of work, which makes the nodes in a network compete to solve cryptographic puzzles using computer power and reach a consensus. Effectively, what's going on is that it chooses the winner at random. And I'll come back to that momentarily. Practical Byzantine fault tolerance is a different way of getting consensus. You choose a leader in a round-robin fashion. The system agrees on a membership list of nodes picked by the company, and centralized consensus is achieved when over 60%, 66% of the nodes agree to the transaction. Proof of stake is another variation. The selected validator suggests the next block for approval, but chosen at random, and that's followed by multi-round voting mechanisms where the votes are weighted more for holders that hold more of the crypto coin. And finally, federated Byzantine agreements. Each entity names others that it trusts. The trust networks need not overlap. Stellar's FBA, for example, is free entry and open in membership into this validation process. Now, there are issues with each and every one of these consensus protocols, and that's going to be the subject of the next section, the fourth component, smart contracts. So smart contracts on a first pass can be thought of as a way of implementing solutions to mechanism design problems. What does contracts have to do with ledgers and distributed ledgers? The contracts are put on distributed ledgers. So think of the state of the system as a balance sheet item, controls as actions or messages, actions taken or messages sent, which result in transactions as in cash flows. And this notion of states and controls and so on is the language of economics, the language of programming, the language of engineering. But that's the analogy to the ledgers, stocks and flows. The messages in particular are put on ledgers, and by the revelation principle, the messages have to be such as to maintain truth-telling. This allows, in addition, multi-period contracts where the past histories of messages are recorded and become immutable because you can't alter the blockchain. And then there are a series of incentive constraints in this notation for the first period, and then for the second period, and then working backwards again back to the first periods and so on. So the point is that the distributed ledgers represent a commitment device in terms of entering into the contracts and also a commitment to the way that the contracts are going to be carried out. You can't complain later because there's indisputable evidence that you had entered into the contract and it's designed so as to achieve the desired outcome. Let's talk about trust again. So again, by the revelation principle, incentive constraints ensure that agents are honest, tell the truth, and obedient, as in moral hazard, although those are additional constraints that make them honest and obedient. We don't trust actors per se to, we don't trust them to carry out in any other way. If there is commitment or limited commitment in the system, then we need collateral or multi-period contracts or some kind of reputation. And again, that's part of mechanism design. We can further talk about unique implementation of solution to mechanism design problems in order to prevent collusion. There is a way to do this, and it can be coded up and put in a multi-party smart contract. So what is the computer science community worrying about exactly? Are they worried about faulty communication among the nodes? Are they worried about nefarious evil behavior? They don't make this distinction. To them, it's all the same. And relatedly, what about equilibrium behavior under the protocol? So there's an emerging literature on Bitcoin that is discovering that, maybe it doesn't work the way Satoshi, or could potentially not work the way Satoshi thought that it would. He had not formalized these systems as multi-party games with limited information. So let me tell you a little bit about the Byzantine Generals problem. In computer science, there's a subset of generals, some subset of whom are traitors, i.e. bad nodes that are either malicious or sending error-ridden messages. These generals as a group have to make a decision about whether to attack or withdraw, and they do so by sending messages to each other. If the enemy is prepared and the generals do not attack as a group, then there's failure. So these generals exchange messages with each other, and if the number of potential traitors or faults is known, and all the other nodes tell the truth, then cross-checking a sufficient number of messages is sufficient to get to the truthful outcome. So roughly speaking, this requires 3F plus 1 replicas to be able to tolerate F failing nodes. So the premise in computer science, ironically, is that most people are honest, trustworthy, one might say, on these so-called trustless systems. In contrast, think about strategic behavior, as Morris and Shin have done. A protocol that does work with high probability, if the signals of whether the enemy is prepared or not have content, and if messages sent mostly arrive and are reliable, the thing that works is that the first general attacks when the enemy, he gets the signal that the enemy is unprepared, and the second general attacks if he receives one message from the first general. And that sequence dominates any other combination of actions and messages. But that protocol is sensitive to strategic concerns formalized as an outcome in an incomplete information game. If the first division general receives no confirmation of the message received from the second, did the second general get the first message sent by the first general? The first general doesn't know. The first general doesn't commit his division to battle because, in effect, the probability is greater than 1/2 that his message was never received. And if he attacks and the other general is also not attacking, then there's a disaster. But likewise, the second division general is reluctant to attack if he has not received a reconfirmation from the first general by the same logic. And the whole thing unravels and nobody ever attacks. There is a solution, ironically, but let me pause there and just say this protocol that seemed to be working pretty well actually doesn't work at all once it's modeled as a strategic game with limited information. That's the Morris and Shin contribution. This should be making you think very hard about what those consensus protocols think that they're doing. There is a new design. The second general is never allowed to communicate back to the first. That's part of the new design. And in that case, the first attacks, as long as the signal is that the informed enemy is informed that the enemy is unprepared. And that works. So a very simple twist in the message space, as it were, achieves the desired outcome. And other people are hitting on the same thing in the economics literature, sending the same messages on multiple paths, sending them repeatedly on the same path, having one informed agent as a central node, as a leader relaying all the messages. These are things that people have shown have good property. So the hybrids would get us into thinking about combining the economics of incentives with the validation protocols. The components are there from both sides. From mechanism design, we know that contracts with costly state verification, for example, are really big sections executed without any messages at all, and hence no need to validate. A version of the revelation principle also works with no messages at all. So we don't have to give up these tools in mechanism design, even when we're thinking about limited message systems. From the smart contract side, if you take a company like Corda, it has validity consensus allowing unique, or what they oddly call non-unique consensus, the latter being information partition ledgers. Corda has notaries. It's an option to have one. You could have multiple notaries that trust each other as validators, or multiple non-trusting notaries. These are all things one could draw on depending on the application. The nodes could be private or they could be public, and for that matter, we could have broadcast communication where everyone's receiving information, or selectively private communication. So people who have written smart contracts in Corda have a lot of options to create these hybrids. Now, there's a lot going on in the slide, but it does kind of tie the discussion so far together. You'll see Agent A at the top and Agent B at the bottom with their balance sheets and their financial accounts. They're sending messages to a, quote, smart contract, and the smart contract then implements transfers. The smart contract is the solution to a mechanism design problem, and the transfers of goods and value happen and revert back to the changed balance sheet. Well, who is this planner? We use that in economics, the planner's problem, but the whole point is one should be able to do this in principle without a planner. Then we have to decide, how is this contract getting computed, and how is it verified that the code is proper? This could be done on-chain, but if it's done through in Ethereum, it's prohibitively costly. I've helped, me and my collaborators, Nicholas Zhang, we've done those computations. So the solution is to take some of those things like contract validation offline, as it were, off-chain. Another cute thing that can happen is that entire documents can be encrypted off-chain and accessed, and since they're encrypted, they're immutable and reliable, which mitigates the need for, sending messages about every particular line item in every document. Just as a practical, obvious thing. Messages and states in the contracts, in that control system I referred to, could be part of a ledger, and in principle that ledger could be separate from the ledger that's used for transfer of value. And finally, we get to multi-party computation, which is a way to share partial information and keep lots of things secret, and yet somehow know that the system is functioning even properly, even though you don't see all the inputs. Amazingly, computer scientists have created MPC tools, but in practice, the more we look, the more, they look more limited than what it might seem at face value. That doesn't mean you can't do it. It just means that in practice, you're going to have to accept some quasi-private, not totally 100% private nature to the transactions. But that's okay. That's very much in the spirit of this whole talk, was to think about the technology and create the hybrids to perform what you want. So let me turn to some universal design issues. First of all, partition ledgers, meaning not everyone shares all the information equally. I have an example earlier in my work of deliberate randomization. So no doubt you can't really see or quickly understand the figure here, but there's 2 periods and 2 agents, and in the first period, an agent is sending an announcement of his or her preference shock, and in the second period, the second agent is sending an announcement of her shock. Insurance means insurance against these preference shocks, but not too surprisingly, once the event is known, you can't insure it any longer. Insurance only works ex ante. So it turned out in this example that it was worthwhile to deliberately scramble the allocation in order to keep the second party somewhat ignorant of what the first party said. So the second party would not know the message of the first, even though the messages goes on to the platform and is executed under the contract. It's not a new idea. Lion in Finance has articles on optimal transparency and order flow information, just to name one, and I have some work with co-authors as well on sharing or not information on on platforms. 2 more things about global designs. Committed delegation. It's actually worthwhile for parties to the contract to surrender their control over the outcomes and let the third party platform or the contract provide the insurance, paying premia or indemnities, not just a function of idiosyncratic shocks, but as a function of aggregate shocks as well, front and back loading incentives. And likewise, mitigating runs on banks and markets, as in Green and Lynn, that can be done with distributed ledgers because they are essentially time-stamped and eventually immutable, so there's a history of the previously reported transactions on the blockchain. So all these ideas are ideas from mechanism design literature, some not so recent, that are out there and actually could be implemented on these ledgers. And things like bank runs are, of course, and runs on markets are a big problem. Decentralized tokens are associated with implementing private partitions. So imagine 4 agents, A and B meeting in one location in the first period, A prime and B prime meeting in a second location in the first period, and then these agents make announcements of their urgency to consume, as in Diamond Didvig, and if they're urgent, they're going to get goods today in return for getting less goods tomorrow, and vice versa. But then they switch locations. A becomes paired with B prime, A prime with B, and so on. That's not really a problem if we have all these messages, because you can keep track of the history of previous announcements, meaning that the previous borrower should transfer goods to the third party, and so on and so forth. The problem, though, is that, as an example, here only with 4 agents, this problem is a problem of scaling. It's not going to scale up very easily, as you can imagine. Everybody sending messages to everybody else, all recorded on the platform, and so on. A decentralized, in the right sense of the word, way to implement this solution is to have people carry tokens. So when the patient agent says, "I'd prefer to eat later," he or she gets the tokens, which then can be presented to the third party that they're paired with later on. And they will have an incentive to reveal the tokens. If they're not armed with the tokens, they can't display them. That's equivalent with having journal entries on the ledgers, but partitioned and private. So it's like choosing to share your own financial accounts as part of the distributed ledger, but only sharing them with some parties and in some circumstances. And something very similar happens when you think about multiple colored coins. Namely, it's not just one token that you need different kinds of tokens. You need multiple colored tokens to keep track of the direction of trade in multiple goods, especially if you can have these preference reversals that make people wish they had done a different transaction in the first period, but you can't go back in time. And this idea of colored coins actually arose with Bitcoin, especially the earlier versions, which were somewhat limited. The analogy in this book, Narayanan, is to stamp things on dollar bills. So someone goes to a Yankee baseball game with a dollar bill, but stamped on the bill is a record of the fact that the holder purchased the Yankees ticket. Or on the dollar bill could simply be a code which would allow the teller to revert back to the distributed ledger for proof that the holder bought the ticket. And this is referred to as colored coins. So colored coins is a metaphor for colored entries on ledgers, meaning distinguishing histories. Some histories have one color, a second history has a second color, and so on. By the way, I'll just point out right here that fiat money can undercut these systems. It's not an accident that the example has to do with stamping information on the dollar bill. A dollar bill with a stamp on it is different from a dollar bill without it. Whereas if you were trying to just use fiat money to keep track of all these histories, you would get garbling, and people with unobserved transactions can undo these high-powered incentives. Let me come to some emerging market applications: financial infrastructure and payments. So there are definitely gaps on the ground. In my Thai project, for example, I can see that risk sharing is good on some dimensions and not so good on others. As far as idiosyncratic shocks, household firm specific shocks, it's actually quite good. There's an enormous amount of pooling of risk through gift-giving networks. And so the risk premium for the idiosyncratic shocks is positive. It's not pooled to zero, but it's quite small. On the other hand, there's a high risk premium on aggregate shocks. If the village were the whole economy, that's what you'd expect, because aggregate shocks cannot be pooled. But if you think about a village in the larger context of the region with multiple villages, those aggregate village level shocks become idiosyncratic shocks in the region. They are, in principle, poolable, and that is not what's happening now. So there's evidence that the insurance markets are incomplete. Another example I've already alluded to, which is cash management. There are huge welfare losses associated with this mismanagement of cash, and other evidence about incomplete contracts. That's not to say people haven't tried to improve the system. The government of Thailand put a fund of 1 million baht in every single village in the country, but with some study, it's become known that the village committee tended to get the bulk of the funds, and or those that were family connected to the committee. Costly state verification regimes work, but those costs of verification are lower if you have kin in the village. So the point is, there are informal systems that are working, but they rely on kinship trust. And if you don't have trusted neighbors, you're living in a world which is limited, and hence there's scope for further improvement. In fact, if you're in a world where some people are in kinship networks and others are not, you can get a kind of contagion going on. If you're in a family network and you get hit with an illness shock, you get to smooth your consumption quite well. But if you're not in an insurance network, then you have to cut back on production, and that spills over to laborers that you hire and inputs that you would have purchased. And those guys go unemployed or start accumulating inventory. So we have a kind of contagion going on within the village that has to do with this reliance on kinship trust networks. The point of this is that distributed ledgers don't rely on those notions of kinship trust. They can work much more generally. And likewise, villages by geography can be better linked up to one another as well. So innovation is happening in two forms. First of all, smart contracts. You can introduce smart contracts that overcome obstacles that are there now. Escrow with non-banks, savings products for automated deposit and portfolio management, securitized waterfall payments along the path of supply chains from buyer to seller, and in turn from seller to employee loans. Another version of that is capitalizing future wage payments. All this is committable. The future is committable, hence capitalizable back to the present. That's what is meant by waterfall payments. All committable and immutable. The second piece of this innovation is a platform for contract competition, as was envisioned in some of my earlier work with Ed Prescott. This is taking the form of EveryNet in Southeast Asia, provides open source banking services and financial contracts to unbanked and underbanked populations. It's an interoperable smart contract platform that enables not only traditional banks, but microfinance institutions and others to initiate and execute banking products and financial contracts, and can include know your customer and other regulatory requirements. That is innovation in financial infrastructure. Now I want to talk briefly about financial innovation in payments. Going back to a developed country, Canada implemented a payment system as a distributed ledger, as an experiment, to see whether it would work for high-value payments among commercial banks. They explored using Ethereum, but eventually moved to Corda to allow improvements in finality, scalability, and privacy. The role of the unique notary in Corda, that option, was played by the Bank of Canada, and the netting promoted funding efficiently and allowed in the program of the contract, the smart contract, a central queue that allowed an account for a specified bounded amount of value to be placed in a queuing option. And when the program is running, the participant could not access that money so that the algorithm can search efficiently for who to transfer them to whom and so on as to get clearing. So you can do pretty sophisticated things. The conclusion of Jasper was that it worked just as well as traditional payment systems. Of course, that's also a bit of a critique that it didn't necessarily work better and they did not implement it, although I am aware, even from a lunch conversation today, that distributed ledgers and payment systems are being given very serious consideration in other countries as well. Relatedly, cross-border payments, especially at the retail level, remain highly problematic. In Southeast Asia, it's going to cost you 7% approximately to transfer value from fiat money from one country to the other, because you're relying on traditional bank technology and limited access to currency exchange markets. Many central banks are working on this. The Bank of Canada, jointly with the Monetary Authority of Singapore, the Hong Kong Monetary Authority, the Bank of England are all working on ideas for efficient cross-border payments, including with distributed ledgers. The one that I'm aware of on the ground in Southeast Asia is LightNet, which allows cross-border payments. It avoids direct payments of the fiat money, but participants can conduct cross-border transactions. A money transfer organization puts value as collateral in escrow, placed securely, and is granted a credit line in fiat tokens that represent the fiat money one-to-one. Those fiat tokens are then transferred across brokers, making their way into the other country. LightNet does this netting and liquidity management very much the way we see settlement layers in high-value central counterparty systems. And likewise, stuff goes on off-chain. Orders are grouped together before sending them off as a batch to Stellar, which has this pre-existing system I mentioned for international fiat transfers. Fiat money never crosses the border. Some words about distributed ledgers and regulation. You may be thinking, should regulators allow distributed ledgers or not? That is not what my take on this is. It's rather distributed ledgers offer a technology which would be very useful for regulators given their objectives. So one version of this is the impossibility of decentralized exchange, known early on from the work of Ostroy and Starr. It's very hard to achieve the Pareto optimal allocation associated with the Walrasian equilibrium by having traders meet pairwise, exchanging values and a quid pro quo condition, knowing only the identity of the two paired agents and their own histories. It turns out it's impossible. One can construct examples. What is needed are the histories not only of those who are contemporaneously matched, but the histories of people those two traders have never even seen before. So in other words, we need a kind of public consensus or distributed ledger at key junctures in order to get around this impossibility theorem. Another related example is some work I did with Neil Wallace on private debt, which circulates and has high value. It can be very beneficial. It can achieve Pareto optimal allocations. One can trace out these chains from issuer to redeemers, just like the tally sticks. And it can have very high velocity, so effectively these are privately issued securities that circulate as money. The problem that emerges is that there are many ways of achieving the same target Pareto optimal allocation, and if these agents are located in informationally decentralized markets, they have no way of knowing what the issue is of the coins in the other markets. That creates a coordination problem, and recently we've worked out with an MIT student what would happen, and if there's lack of coordination, what will appear as a slow-moving financial crisis. So regulators should be interested in having public consensus ledgers at issuance dates so we know ideally how to avoid these kinds of coordination problems. Another comment on regulation, it's not going to be traditional. Distributed ledgers allow commitment and trade restrictions. It's known from the work of Mikowski and Pessendorfer, for example, that even having infinitesimally small providers competing against one another can nevertheless fail to achieve or complete markets due to a lack of coordination, as in a Nash equilibrium. So things should be done in a more coordinated basis. Likewise, from Jacqueline, we know how to destroy Diamond-Dybvig's solution, but regulation can prevent those kinds of ex post trading because of the commitment and immutability of the ledgers if they're designed properly. And I've done a lot of work lately on how to allow competition across cryptocurrency exchanges, how to eliminate fire sales and pecuniary externalities, and how to design financial markets and so on. So granted, this is early on, but very much as before, instead of drawing on somewhat dated work in mechanism design and so on, this more recent work provides blueprints for how we should think about designing the system. Philippon, who was on a panel, I think, earlier today, has a well-known paper called The FinTech Opportunity, and although he's positive about fintechs, he's very skeptical that regulators are going to be able to adapt and think about regulation in a different way that they need to in order to allow the innovations that the fintechs could eventually provide. But you understand, I'm not saying any competition goes. It's very structured design, market design competition. So my next to the last slide here is on cryptocurrency and the role and value of tokens in economies with distributed ledgers. Tokens and cryptocurrency do satisfy the velocity and frequent use in payments definitions of money. They are money. And there is room for them because typically there are gaps in intertemporal marginal rates of substitution. From monetary theory, the value of fiat money is endogenous and potentially indeterminate. And we lose those fundamental welfare theorems, as I said. In fact, there's a whole literature on the optimal size of bubbles, and all of that carries over to thinking about cryptocurrency values is a potential explanation for why crypto values are unstable and seemingly indeterminate. It just comes with the territory if cryptocurrency is like fiat money. There are ways, of course, to think about value being pinned down by taxes and legal restrictions like cash in advance, and likewise here, crypto can play a role as a utility token in mechanisms that's required for participation in the mechanism, and hence the crypto coins would have value for that reason if the service offered by the company has its value. So either way, cryptocurrency has value or playing a role on top of fiat structure. The indeterminacy, inflation, speculation have remedies in the same roots of monetary theory, things like interest on currency, interest on reserves, central bank reputation, or in the crypto context, digital reserve bank commitment for how it's going to implement its token reserve policies and requirements for use, giving a minimum lower bound to the value of the currency. So smart contracts and algorithmic digital reserve systems can implement optimal activist monetary policy. I should have written optimal activist token policies using the transactions data that you would get from a system like LightNet. So in summary, get rid of the hype, get rid of the misleading definitions. The potential, to me, is quite clear from the needs we have, given the problems of existing markets and financial institutions, and also from actual ongoing applications, and I've given you some examples. We need to go further in terms of redesigning financial infrastructure and payment systems. There are some innovations that I outlined that have not yet happened, but I think that they could. It's a mistake to bundle all components together. There are innovations possible for components individually. Those components, to review, were ledgers as accounts, money as and e-transfer systems, cryptography, and smart contracts, multi-market mechanism design. Economics and computer science can be better integrated with each other at each component. Hybrids, in fact, are used in practice even if not all sides will fess up to the problems. But hybrids need to be optimally designed, embraced as the possible new system of the future. Distributed ledgers can be used for regulation, and that should come with new framework for regulators, new ways of thinking about these problems, as I've only had time to outline here. And finally, cryptocurrency and digital assets do have roles to play. The problems and the potential to solve those problems is better understood through the lens of mechanism design and monetary theory. So that's the end of my formal talk, but I'm eager to get comments and questions from the audience. Yes, I must confess that I have glaring spotlights staring at me, so I can't see you very clearly, but please go ahead.
My question was about what's your opinion about central banks' digital currencies versus distributed?
Okay, the question is, what do I make of central bank digital currencies? So, in some respects, I think they're not that distinct from the way that the system is already evolving. It's just giving a direct retail link of customers to accounts at the central bank, as opposed to potentially doing it only through commercial banks or doing it through non-bank financial institutions. And again, I only recently learned that WeChat and other such platforms in China have 100% reserves at the central bank. So it's very close to a central bank digital currency already. The rationale for these things does vary from one country to the next. The Riksbank seems to feel that Sweden is vulnerable to purely privately provided payment system, and that they, as a central bank, have a public role to play in providing some ultimate backstop if something goes wrong. That's their take on it. There are many experiments going on. The number of institutions, countries that have actually adopted it is relatively low given the efforts. I think the South Africans are about to implement something at the retail level within the year. So I'm not adverse to it. But like all things that I've said in this talk, I would need to understand better the economic environment. I would need to look at the gaps that potentially exist, and then think about, what is central bank digital currency doing in terms of remedying and potentially allowing improvements, rather than just thinking about it as yet another system. Yes, question over there.
So if I could follow up on the central bank question, one issue with the national crypto fiat is potentially the government sees every single one-year transactions. So I'm just wondering if it's practical to adopt something like that, or if you have to go to a zero-knowledge blockchain construct. Do you have any thoughts on that?
I agree. Let me repeat the question, which is, do things like central bank digital currencies require that every transaction be seen at least by the central bank? And alternatively, what about these multi-party MPCs? Can that provide the way to obscure the information? As I said during the talk, I've been quite eager to think about partitioned ledgers because I can see the value for it in many economic environments. When push comes to shove, multi-party computation looks more limited than I thought it was initially, but I suspect there's compromises that are somewhat between the two endpoints that you outlined. And I'm sort of thinking about that, but I don't have any further thoughts to share at this moment. Yes?
Can you maybe elaborate a little bit more on the, I mean, this is related in some sense to this Camp's question, on the benefits and costs of anonymity? I guess a lot of the advantages and components of cryptocurrencies are pushing those, the value of anonymity.
So my thinking is very heavily, so Adrian's question is, how does one think about anonymity as a value in itself in the context of this discussion about distributed ledgers? My thinking is so heavily influenced by mechanism design, where you're not, you can impose reservation utility constraints so that all the participants are willing to enter in or not, as the case may be. And typical solutions to mechanism design problems don't try to keep everything secret, but on the other hand, they don't typically insist that everything be public. So the mechanism, the solution is telling us the Pareto optimal degree of anonymity. That's the way I think about it. Now, that said, mechanism design is assuming a lot, namely that this is the only game in town for a given group of agents and they can't do side transactions, or if they could, then that's also incorporated as constraints into the problem. This is not what we see currently with Facebook and other big tech providers, because they clearly are getting a lot of information from their customers who may or may not be well informed about the uses of the information they're providing. And the aggregators, for example, sell information. Banks hand over information on customer accounts, which the aggregators then do big data analysis and sell the results back to the commercial banks. And all of that is not within the scope of mechanism design. So I share the concern about anonymity. Maybe I'm just too optimistic that when one lays out the mechanism design approach that could take hold and help deal with that issue. Yes?
Hi, Professor Townsend. My name is Luna. I'm from UMass Boston. I'm a job market candidate. So my question, I'm trying to get the gist of this entire cryptocurrency knowledge at the surface that I can explain to my students. So you're basically saying that cryptocurrency, I know you're talking about distributed ledger, which is like the fundamental part, component of that. But in general, cryptocurrency serves as the role of money in terms that it is a medium of exchange, and it is a store of value. The two major challenges that you were talking about, one is the information technology security. As in, even though it is designed to be irreversible, there might be hacking that changes all information that is stored on there. And two, you were talking about because there's no central bank backing, it's not pegged to the US dollars. Therefore, it does not serve as maybe a store of value. Am I understanding it right?
I'm getting some of this question, but not all of it. First of all, in the part of the question about cryptocurrencies, I didn't spend enough time on it in the talk because some of them are fully backed. So you can exchange value with these tokens, but in the case of fully backed systems like a narrow bank, so that the customer's deposits and so on are actually secure. Libra, or versions of Libra, are proposing that an international basket of currencies, the yen yuan and so on be part of the backing. Of course, that does take monitoring, and in the second slide I noted that the stable coin was supposed to be backed by 100% by dollars and was not. So there does need to be some monitoring to prevent that kind of fraud. Can you repeat the first part of your question?
So the first question is basically, do you believe that in the future, cryptocurrency can serve as important a role as cash, as a medium of exchange, or as a storage of value?
Yes, I do. But I don't think it's, the question is whether I believe whether cryptocurrency can play the role that we now see of cash and fiat money in terms of medium of exchange and store of value. My answer is yes, because we already see versions of cryptocurrency doing that. But what I was trying to say, for example, with respect to LightNet, is that you can have dual systems where cryptocurrencies are operating on top of fiat monies. In fact, Stellar is all about transferring fiat money values around through tokens. And if there were no fiat money, there would be no Stellar. So I don't necessarily see it as in conflict. And Satoshi did clearly think of cryptocurrency as an alternative and a way of, quote, getting rid of fiat money because he didn't like the aspect that fiat requires trust. In the U.S., Britain, Europe, largely, all these countries, the central banks are they have forward-looking expectations, they're trying to maintain their reputation. Fiat money works pretty well in those contexts. So my goal is not necessarily to replace that functioning. But likewise, when you think about Venezuela or Argentina or Zimbabwe, where you have misbehaving governments and rampant inflation, then, cryptocurrencies have come in to try to stabilize value and allow transactions. So the advantage of the ledgers is the degree of commitment, which is programmable, and I stand by that part.
My understanding is correct. Currently, we have like thousands of different kind of cryptocurrency. Do we need that many? That's my question.
Yeah, some come and go. How many ought there to be? So this work I alluded to on competition across cryptocurrencies, the underlying premise there is that there's some diseconomies of scale that will kick in eventually due to this scaling up problem. All the consensus protocols, Bitcoin being the most onerous, displays some version of a scaling up problem. So if that's true, and I believe that it is true, one would not want to do all the transactions with a given cryptocurrency, but rather think about having multiple cryptocurrencies. And then the usual theorems about competition kick in. Namely, you can imagine an outcome, and we proved this theorem, that competition among cryptocurrencies will lead to Pareto optimal allocations. But the size and number and composition and types of these cryptocurrencies and the platforms would be determined as part of the competitive equilibrium. I don't know whether that number is going to be 5 or 500, but it would be finite and not one. Yes, Ken.
You mentioned several times in the presentation that this is paraphrasing, if I knew more about frictions and the issues we were trying to overcome by know about the circumstances, characteristics of the country, whatever, you suspect, if you don't immediately see, there are major design problems. There are issues there that this could have been put together differently, or given the way it's put together, the following aspects of regulation need to change or need to reasonably rapidly evolve. Have you come across examples like that that would sort of take these frameworks and actually say, we should do this differently?
Yes, I have. Yeah, Ken's question is whether, in my experience, based on elements I presented in the talk, we can delineate circumstances where the innovation is going down the wrong path, and that I would have recommended that they potentially do something else. So my answer is that this is related to what I was complaining about at the beginning, which is this hype and exaggeration in the industry. There are many companies proposing distributed ledgers. It's almost like a catch-all word now. You're almost embarrassed to say that nope, we're not doing distributed ledgers. Even companies that are essentially not doing very much want to embrace that terminology. The second thing is like the distinction between, say, tokens as a digital asset for the transfer of value does not necessarily require cryptocurrency exchanges where you can cash in and out from fiat to tokens and vice versa. So I've had experiences where I would have recommended that they decouple the problem of unstable values from the coin that they need. Now, again, there are fundraising issues, and given the hype, it is often thought that issuing a sexy coin will allow you to, capture some of the seigniorage. But to me, some of those can almost, let's just say, can be very problematic if effectively what they think they're doing is pulling the wool over the eyes of the customer. That's my best answer.